an investment perspective, again, what we're seeing now is a period of price discovery, like we're seeing across most of the world, Western Europe even, and I would say typically that with a reasonably strong base of international capital who are largely sort of playing a wait and see approach until those prices have adjusted. In contrast to where Western Europe is currently doing the same. So I think on average we've moved our yields out by circa 50 basis points, and maybe a little bit more in some cases. Western Europe's done the same, but I think the general sort of consensus is that we could expect to see a little bit more, particularly as inflation continues to be strong, and that's obviously being reflected by central banks' changes in interest rates, which are causing the debt markets to be much more expensive than they were 12 months ago. I mean, fundamentally, the market's still performing really well, contrary to what we might see in the broader economy. I mean, there are a number of risks that still could come in, but we're seeing generally good demand for good office space, particularly those that are addressing ESG, particularly from a sustainability point of view, going forward, as in light of the energy crisis. Logistics still very much in demand. We've got very low vacancy, less than 5% across the region, and as low as 0.6% in Czech Republic, for example. So as a result of that demand, from whether it's from nearshoring or adding in more business services into the region, which has been a really strong driver of demand in Poland, Czech Republic, Hungary, for example. We're even seeing some good levels of rental growth in these markets. So there's some really good stories there to offset some of the slightly more negative things that are coming through.